Welcome to the Whitwam Wealth Real Estate Podcast. Today our topic is real estate investing with high interest rates.
Welcome to the Whitwam Wealth Real Estate Podcast with Scott Whitwam, your blueprint to financial abundance. Settle in as we explore the mindset and methods for wealth building through real estate.
Welcome back. I'm Scott Whitwam, and I'm glad you joined us today on our podcast for real estate investing with high interest rates. Let's just jump into it. You know, like one person I know says, I don't think anything about high interest rates because I don't pay any of them. I pay cash. Now, for the rest of us here on planet Earth, let's talk about interest rates and real estate investing. Here's what we're going to cover in today's podcast. Number one, what investors face now. Number two, bad news on rates. Number three, issues and interest rates. Number four, predictions. And number five, strategies. So let's get started with number one, what investors face now. For us as real estate investors, even if we have cash for an investment, we may choose to use other people's money and leverage our acquisitions. Interest rates affect the cost of leverage or our cost of borrowing the money. Just as if you put money into a fixed investment like a CD, interest rates affect your rate of return. We generally discuss these rates in the form of percentages based upon the annual cost of that leverage. Interest rates can also affect cash investors when considering their dispositions of a real estate asset. As a real estate investor and as a borrower, it doesn't matter if the money is coming from an equity investor or it's coming from some type of investment loan like private funding or hard money, the interest rates will be a factor in the overall project cost basis. And these costs continue to rise. A retail borrower, borrowing from a conforming lender, Fannie Mae, Freddie Mac, they go down to their local bank. The interest rates they have to pay will determine their ability to purchase our dispositions. This could affect our price point significantly and our bottom line. Lower interest rates makes our disposition properties more affordable to a buyer, both on the wholesale and retail side. So an investor faces interest rate dilemmas twice, once when they acquire the property and again when they dispose the property. These interest rates for both the investor, and which would be us, and the retail buyers, they're influenced by a myriad of factors like Federal Reserve policy, the rates of inflation, economic growth, market demands for credit, all those type of things. As we've seen so far this year, interest rates remain a critical factor for investors. Interest rates influence the cost of other people's money. It also affects the pool and number of available buyers that can obtain credit to purchase the properties we're trying to dispose. So today, we'll consider current interest rate trends and predictions for, where they may be headed this year and what this means for us as real estate investors. So number two, bad news on rates. So where do interest rates stand today? Are interest rates extremely high? If you've recently shopped a deal around, you certainly know that they have changed over the last year. To determine if rates are actually high or not will depend on the measuring stick that we're using. There is no doubt that they're higher than they were previously. If your whole investing life you've seen or experienced conforming rates of 5% or under, or private and hard money rates sub 10%, then your measuring stick may say that interest rates are high now, and any more move upwards will put them off the charts. However, if you've previously experienced investing and lived, back when interest rates for conforming mortgages were 10% or higher and private hard money rates were 18% and more, then things may appear more moderate to you and more sustainable. One factor, more than any other, amplifies the cost of credit and makes interest rates feel high or low, and that is the value of property. When real estate values are high and interest rate climb, it amplifies the interest rate. It looks, as if things have gotten even more expensive because obviously the cost of other people's money becomes much more expensive. But let's look at some other factors affecting us right now. According to U.S. News, interest rates from their lows in January of 2021 to the end of 2023, these interest rates have jumped or increased by 340%. 2023 saw the Federal Reserve tease that a series of rate drops would likely be coming in 2024, starting in Q1. Oops. The government, like a rookie second baseman, made a critical error at a very inconvenient time. After all, this is a presidential election year. How then can the Federal Reserve allow sound economic policy to get in their way of a stronger economy? In quarter one of this year, the government had to revise their employment numbers down by nearly 500,000 jobs. Yes, they counted and announced that almost 500,000 new jobs were created that weren't. The Federal Reserve looks at the information put out, regarding unemployment numbers and makes their predictions. So in December of last year, the Fed was talking about rate cuts this year based upon how good the economy was looking. But when you take out nearly 500,000 jobs, it shows us that the economy was not nearly as strong as had been reported or estimated. The Fed, armed with unemployment revisions and inflation numbers that doubled their target rate, they put the brakes on the interest rate cuts. They announced that additional rate hikes now may be necessary to combat inflation in the future. So they went from talking about rate cuts to potential rate hikes, calling these necessary moves to stabilize the economy. However, what is good for the Fed may not be good for you and I as real estate investors. It leads us to higher borrowing costs, not only for us, but also for consumers. And it slows the consumer's desire or ability to borrow and purchase. Private money and hard money lenders are not borrowing from the Federal Reserve to fund your investment projects. So why did their rates generally outpace mortgage markets? The answer to that is just simply risk and reward. While a Fed rate, like currently sitting at about 5.33% right now, private money investors now have other more secure options that can provide them the rates of returns that they were getting when these private money lenders were offering 10% and sub 10% rates. So why would they provide lower interest rates to you, even if they're not taking Fed money? Believe it or not, investors, yes, you and I, are considered high risk. That is why hard money lenders, they only provide us, 60 or 70% of acquisition cost of a deal. They want you to have lots of skin in the game so that they can trust that you're going to stick with this and not bail on a project. And they do this with good reason, as hard money lenders are, exercising more takebacks than we've seen in the last 10 years. That's investors who got out over their skis and didn't prepare or understand how interest rates affected their real estate investing. So number 3, let's talk about issues and interest rates. Issues are just opportunities for a creative investor. There are some factors that are interfering with our interest rates right now, and there are some factors that we must watch cautiously. One would be inflation. The Fed's primary tool to control inflation is adjusting the interest rate in order to manage and control inflationary rates. And this controls the rates at which banks can obtain funds in order to lend. This is a little bit different than the mortgage-backed markets or mortgage-backed securities or bonds, but the mortgage-backed securities in general follow the Fed rate. So if the Fed rate is going up, you're going to typically see mortgage-backed securities rising also. If inflation remains high, the Fed might continue to raise rates. Mortgage rates will continue to follow that pattern. However, if inflation shows signs of cooling, we might see a pause or even a decrease in rates. One can always hope. Number two is an economic growth. Strong economic growth can actually lead to higher interest rates, and this is a means of slowing the economy and preventing shortages and even higher inflation. If the economy shows signs of slowing, the Fed might lower rates to stimulate growth, presuming that other factors are also in line, but it doesn't look like we're going to see that in the near future. The third thing would be global events. Geopolitical events, global markets, and other extreme factors like wars can also impact interest rates. For instance, supply chain disruptions to shipping lanes affect economic stability and influence the Fed's decision. Since 2022, it seems like these type of factors have been nonstop. So that we get to number 4, my predictions. I could sit here and spout out what Chase Bank or Morgan Stanley thinks, or what one of the prognosticators on the major financial network has said. But if you'd like another incorrect market prediction, you'd be better off getting it firsthand from them. Let's quickly look at 3 areas. First is Federal Reserve and the overall economy. Second is interest rates and home sales. And third is real estate investor markets. Number 1, I think the Federal Reserve will do its best to protect the party in power in this election year. Even though the Fed has indicated it will remain vigilant and fight to bring down inflation, they may be forced to issue small rate hikes maybe in June, but I don't think with an election pending, the Fed has the tools or the authority to control the inflation problem. Ultimately, in late summer or in early fall before the election, we maybe see 1 or 2 small rate cuts. These will be more symbolic than effective. So I would expect the trend that we've seen to be a trend that continues. It means continuing interest rates in the area of 7% for consumers and 14 to 18% for hard money lenders. Number 2, stable rates in the 7s. That will continue to affect home sales. If home sales meet more lingering challenges, the current economic policy seems fixed on keeping that trend in place. Again, the Fed really doesn't have the tools in place to fix this and doesn't have really the economic backing of public policy to really do much more than try to control inflation. Home buyers will become accustomed to these new levels of interest rates. They did back in the 1970s, they did in the 80s. They'll become more accustomed to it, and as they get comfortable, they will begin then to come back into the marketplace. Generally in the hotter markets first, like Texas, Florida, Georgia, and Arizona, it can continue to be stifled in other lower marketplaces like New York, New Jersey, New England states. The wild card will be the November election, which can change, buyer sentiment and confidence, even with elevated interest rates. Like I said, it's a wild card because the November elections could bring news of a recession with no public policy changes in sight, which will further slow the housing market. If this happens, you will likely see interest rates in the 8% range. So number 3, what impact will this have on real estate investing? What does this mean for us as real estate investors? Higher interest rates can have positive and negative impacts on our investment strategies. First, the cost of leverage for investors may be higher. This can reduce cash flow from rental properties and make it more expensive to finance new fix and flip deals. Investors need to factor in these higher costs when evaluating potential investments. Secondly, property value challenges. Between homes without mortgages and homes that were financed with interest rates when they were around 3%, these homes represent a significant amount of inventory that would typically come on the retail market that are not. Who wants to sell a 3% mortgage and get a 7% mortgage? This will likely keep inventory levels lower and keep prices higher. With borrowing costs at a 10-year high, with higher real estate costs, this will likely dampen the real estate potential, leading to slower price growth and even price declines in some markets. Number 3 will be the rental demand. On the flip side, higher mortgage rates can push more people into the rental market, increasing demand for rental properties. This can be a boon for landlords who can potentially increase their rents. All right, the last one, let's talk about number 5, strategies. Given the uncertain direction of interest rates, here are a few strategies to consider. First, disregard current rates. If you're planning to acquire new properties, consider alternative financing options that involve some type of seller financing. We've been doing that on the commercial side for as long as I've been involved in commercial, over 30 years. We generally get some kind of seller involvement in the sale of businesses, and so it's not uncommon. Take advantage of sellers' existing rates if it's viable. Seller carrybacks, wraps, those type of things can be a really viable tool in this market. Secondly, diversify your investment. Diversification is a form of protection. Consider balancing your investment strategies to match your markets. Consider buy and holds for some of your fix and flips or wholesale properties. Or maybe blend in a market-friendly sales niche, like selling with lease option along with other disposition options that potentially can make it easier for buyers to acquire your properties and maximize your returns. And third, and focus on cash flow. In high-rate environments, cash flow becomes even more critical. This can include adding new geographic areas to your mix. You may need to expand your locations. And stay informed. Keep a close eye on economic indicators. Stay informed will help you make timely decisions and adjust your strategy as needed. So my conclusions, if interest rates do continue to rise, make sure you bake into your acquisition cake these interest rates. Stay in communication with your leverage partners so you know what challenges and what changes are coming in the financial markets that will affect you. Thank you for joining me on this episode. If you found this episode helpful, be sure to subscribe and leave us a review. And if you have any questions, we'd love to hear from you. This has been Scott Whitwam. Be sure to join us on our next episode of the Whitwam Wealth Real Estate Podcast with your mindsets and methods for wealth building through real estate.